freedom isn't the result of wealth. It's the foundation. Welcome to Wealth Independence, where freedom leads and real wealth follows through battle-tested strategies, hard-won lessons, and real-world experience. You'll discover how to accelerate your path to true financial independence. And now your hosts, Dustin Bailey and Adam Penn.
All right, welcome back to the Wealth Independence Podcast, where freedom leads and real wealth follows. I'm Dustin Bailey, here with Adam Penn. Adam?
Hey, Dustin. Happy to be here today. Excited to talk about pivoting today.
Yeah, man. This is, and not in the basketball sense, right?
No, we're not basketball players.
I love basketball.
Me and you are not athletic. Don't give people the bad idea that me and you.
I played basketball when I was in middle school.
I'm just tall. Everyone always said I should play basketball, but I'm not a sports person.
It is an unfair advantage. Being tall does give you an unfair. Like, you don't have to be. If you're super tall, you can be not athletic and still be.
I was like 6 foot in 7th grade.
That's an advantage.
Yeah.
Well, anyway, on to the things that are not related to basketball. I think today we really wanted to talk about pivoting, as Adam said. But I think one of the things, like, everyone gets really focused on the entry to an investment, right? Like when you get in, and especially if there's a lot of hype, there's a lot of FOMO. If it's something that's really hot, Trump coin has been very popular recently, and you get all these things that come up. And I think especially a lot of this happened during the cycle that was going through 2020 and 2021, and everything was just running up and up and up and up, and everyone was focused on getting in. But I think how you get in as part of the story, you generally should not enter anything without also having an exit plan, and also thinking through, okay, what happens if my thesis on this doesn't continue to play out and it doesn't keep going up and up and up, and knowing how to pivot when market conditions change. And so that's really what we want to talk about today. I think that's a very important thing, whether you're, regardless of what you're investing in, if it's stocks, if it's real estate, if you're completely passive in real estate, like this, knowing that, if you're a passive LP, you want to invest with a GP who is thinking about these things and who is able to lay out kind of this same thought process as part of their initial investment. Because if not, then you're kind of bought in and it's too late, right? So I don't know, Adam, I know you said you had a personal story to kind of kick this off.
I can. I started kind of my investment career as trading foreign currency. So that was something I did in college. I had a small portfolio in college. I think it was about $15,000. It might have been 20. I'm sure it went up and down around 15 multiple times, but it was foreign currency. It was highly leveraged. And I took a course on it. I took a course that was called 12-Week Transformation with a guy named Jason Stapleton and Akil Stokes. And it was a 12-week course about foreign currency trading. And the first 4 weeks was all about psychology. It was all about, when you enter into a trade, knowing where you're going to exit, right? If you come in and you buy Euro USD at, $1.10, maybe your stops are at 108 and your profit targets are at 115, and nothing changes after you enter the trade, right? You've done all this research, because it was all technical trading. You've done all this research beforehand, the pattern set up, and you've decided that this is where you're going to execute on. And it's not like it executes at $1.10 and now all of a sudden it's at 108 and you're like, oh, I really think it's going to go back up, right? So I'm going to hold it just a little bit longer, right? Like that's how you lose money, right? You because no trader is a 70% trader. Most of us are 40 to 55% traders. Most successful Wall Street traders trade under a 50% win ratio, but they outsize their win to loss performance. So, if we had a 2-cent loss on the downside, maybe we have a 4 to 6 cent gain on the upside, and maybe we can trail off our position on the upside when we start buying, when we start selling, right? We'll take profits at, half of our profits at 2 cents, half of our profits at the other half at 4 cents. And, so we get a 3-cent upside. So that mindset has really, I think it's based a lot of my investment decisions since then around that, just knowing that there should be some type of entry and exit point. And it's not bad to have multiple exits, right? There were things inside of technical trading that could change your targets, not only your stop losses, but especially your targets. If the pattern moved outside of where you thought it was going to move, it retracing back to the point where you thought you were going to take profits might not be that point anymore. It might be a less profitable zone, but you had that plan going in, right? You weren't willy-nilly. I remember one time in the morning, because we were all got on these group calls of about 100 of us, and it was just a chat room, and Akil would live stream, and he went through and did a trade, and it was something I was looking at, but I wasn't fully prepared to enter it, but he entered it. So I entered it and I put in the chat, oh, I'm in on that one. And he said, why? And I didn't have an answer. And he stopped talking. He said, Adam, why did you enter that trade? And I just freaked out. I had no response because I didn't have a real reason, right? And he's like, well, maybe go back and, review the module, but we'll move on for everyone else, right? But that was, it's a mindset that you enter for a reason, you exit for a reason. And the reason should not be, well, someone else did it.
Mm. Man, that's so good. I've never heard that story before. We were talking just before we started recording here that I'd never heard about your technical trading career. So that's super fascinating. But you're exactly right. And you talked about having multiple exits, and it's something I think last year in the newsletter I wrote one or two pieces about exit strategy and how important that is, and that you need to have that established ahead of time. But then also, as you said, the importance of multiple exits, right? If there's only one way to successfully exit a trade or an investment of any kind, that's kind of inherently more risky than something that has multiple ways to exit. And even if some ways are lower return than others, you still have multiple ways to at least recoup your original investment. And that's super important.
Did you have? I mean, I know that as you exited Twilio, you had you started exercising your options, right? Which other coworkers of yours didn't. Do you want to talk a little bit about that?
Yeah. So that was, I was working at the startup segment, and when the Twilio acquisition it was unexpected because we were really on the IPO path, but it gave kind of in some ways within about a month had instant liquidity of a lot of stock options, and I had more that were continuing to vest every single month. But it was interesting because this happened into 2020. And so 2021, right? Like the market's just roaring. I mean, it's especially tech stocks. Anything tech related is just going straight to the moon. And so I had options that were vesting monthly, and then we'd have windows when I could exercise them. And I had already decided really at that time, I knew that I wasn't going to stay in tech. I knew that I wanted to be in real estate full time, and in order to kind of power that and to be doing more investing, and then also cover life expenses and things, I needed some liquidity. And so the options were great for that, right? And so as things would vest, the moment I could sell them, I was selling them, and really kind of irrespective of price. And some of this was just where, thankfully, my options were so far in the money, I really didn't have to worry about any kind of volatility. I mean, they were very in the money. But at the same time, it's like each month, it's like, okay, a new group vest, and it's now at a higher point than last month. And the month, it just keeps going and going and going. And when I would talk to some coworkers about this, obviously, you had a lot of folks that were getting very, very wealthy on paper through this. And when I would mention, I sold this, and they're like, are you selling them all? And I'm like, yeah, I sold everything. And it would just be met with, like, especially from some folks who are more financially minded and were, they'd be very much into crypto, and that was buying NFTs and all the craziness that was going on in 2021. They'd be like, well, why are you selling? And like, don't you think it's going to keep going higher? And I'm like, well, yeah, I mean, I obviously hope so, but I'm not sitting here, betting on it. And the stock price, I think sometime around at the very top, it had gotten over $400. I actually think it went over like 470 or something like that. But I can remember we were seeing research. We would look at the different the places that track Twilio stock, and they would put their price targets on things. And we'd look, and this person says, oh, within a year, it's going to double, $800. And of course, then it's like, oh my gosh. And I sit there and go back into my spreadsheet, and I'm like, okay, well, how much money am I leaving on the table if I sell all this stuff? What if I just wait a year and it goes to 800? And then every single time I would do that, obviously that would produce some eye-popping numbers, but it was like, that's not my plan. My plan here is to sell this and turn this into liquid cash that I can either live off of or invest or use to build the business or all of the things that I need. And at the end, even though like you would have these eye-popping numbers on the spreadsheet, at the end of every single one of those sessions, I would always come back to, no, that wasn't the plan. I'm selling this. We're going to stick with the plan. And so I know that's a little bit of a different thing from like having multiple exit strategies. That was not the case there, but it was more of like I had a plan, and regardless of all of this craziness that was going on, I wasn't really going to pivot away from that plan in order to take, say, a riskier position and potentially try to like take something else that was outside of the plan.
And obviously you didn't know this now, but what is Twilio trading at now?
I should have looked this up beforehand. Was it in the 70s last time?
Yeah,
113. Okay. That's pretty good.
113. So way below what you exercise most of your options at.
Way below. Yeah, and I'm looking at the chart now. I think the top tick was in February of 21 or something like that, at like 430, something like that. So yeah, I mean, it was way, and honestly, at 113, I guess my options would have still been in the money then. But there was a period of time as things came crashing down that, like, had I held on, the options actually would have no longer been in the money. And so this whole thought of like and I feel kind of bad. And obviously, I don't know what any of my coworkers, what they ended up doing financially, whether they sold or did some of this, but I got a lot of crazy looks. And so I know a lot of people who were holding on, expecting it to go to $800, $1,000 or something like that. And again, I had reasons. I would do the financial research. We were trading, I think at that price, we were trading at something like 70 times sales. I mean, there's no world in which that makes sense, right? Like that's a stupid valuation. And so I think looking back on it now, it's very clear, right? Everyone's like, well, yeah, that was kind of crazy. But like to look at that and think that was going to double from there.
Yeah, 140 times.
And I knew that at the time, but there was so much craziness and so much froth in the market that everyone was just convinced that was what was going to happen. And so that for me has been, again, a big thing, and maybe not necessarily pivoting, but like sticking to a plan. Like I went into this when the options became liquid and I started having the ability to exercise them. I had a plan, and I knew what that was, and I wasn't going to let these like external what ifs influence that plan. And so really like sticking with, okay, this is my exit. This is the direction that I'm going. We're going to stay on this path. And it worked out well. I mean, again, in hindsight, it was definitely the right decision.
I think, like you said, just sticking with the plan that you've created. And I think that's really important in any type of investing, whether or not that be an LP in a real estate deal or any type of just general stock portfolio, going in and having a plan. If I have a small stock portfolio, I don't keep much in it. I think it's $2,000. It's really quite small. But I just kind of got back into it recently, and I think I found an old brokerage account and transferred $2,000 into it. But it's one of those things where I'm like, my strategy for the most part is long-term hold, and I don't really look at it, right? I'm just assuming that I'm going to toss a little bit of money in there. I bought long growth stocks that I believe in the company, and they just sit, right? I don't look at it. I think I dump a few $100s into it every month, and it's really not. It's not what I do for investing, but it was I'll follow it. We have a lot of our LPs come in from the stock side, so I'm like, I should be involved in a little bit, follow it, understand it, see when things move, and it's something I used to do. Right, I used to keep a lot of money in there before we really deployed everything to real estate, or kind of in the interim when we'd save cash. So I think that might be a good time to talk about some of the deals we've done, and I'll kind of focus on the short-term rental funds that we have, right? Because that's an interesting space. It's somewhere where we have had to have a little bit of a pivot, or maybe it hasn't been a huge pivot, but the market has pivoted, right? And so we're having to have a conversation about, well, what does this look like for the future, right? Because when we started investing, I started investing in short-term rentals in 2017. And from 2017 to today, top line revenue's gone up a little bit. Expenses have gone up a ton. I don't know if you've noticed in the last 4 years, expenses have kind of skyrocketed. Something happened. Not quite sure what. And then
the Inflation Reduction Act happened.
Yes. Yeah. But I thought that was supposed to reduce the inflation.
Yeah.
Okay. Well, at least everyone's pardoned. So we'll go on and say that the deals haven't been bad, right? We're still cash flowing on short-term rentals. But if you look at that middle area there, right? If you just look at the two ends, the beginning and the end of where we started and ended in short-term rentals right now, it's kind of a reasonable expectation on top line revenue. But there was this oddity, kind of like you just talked about in 2020 and 2021, where rents were going crazy, right? I mean, long-term rents as well as short-term rents. Occupancy was through the roof because there was no more international travel. So everyone that wanted to go on a vacation was going to some local destination they had never been before, right? I mean, up before COVID, I had been to more countries than I'd been to states. And so when we saw all that local domestic travel happen, all these Airbnbs popped up, partially because the demand was there. And so we're in markets where that demand is... It's not a tourist destination, right? I mean, I've got stuff in Chico, California, and that's fine. There's a college town. Once again, back to pre-COVID. We've got some stuff in Memphis, Tennessee, and then we've got some stuff in Tampa, Florida. That's more of a college or more of a travel destination. But all of these markets are not doing what they did during COVID. And so, really coming in with an idea of a pivot, right? Or what our backup plan is. And everything we've always bought has always cash flowed as a long-term rental, right? There we have some properties in Memphis right now where it's like our expenses have gotten higher from the turn cost and our nightly rates have gone down. We used to get $110 a night on average, and now we're seeing closer to $85 a night on average, $80 on average. Still profitable, still paying the bills, right? We have low loan to value in there.
Yep.
And, we do everything we can to minimize costs, but it's not as profitable as it was. So is it time to pivot to a long-term rental? And this is kind of a waiting game we're seeing. We've done some more mid-term rentals where we've gotten month-to-month things. But once again, having that optionality. And if you go back and look at our original presentation that we did on this fund when we launched it, it was, we're going to do short-term rentals. And if, God forbid, those don't make sense or they get outlawed by a local government, which we try to pick places they don't. But if they get outlawed, then we can always go mid-term rental, right? Most places is, month-to-month is not considered short-term. We go furnished midterm to nurses, which we're doing some of right now. And then we could always go back to long-term, whether or not we get rid of the furniture in there or we do it as a furnished long-term rental. There's a lot of options of what we could do with these properties. And we're starting to implement some of those, right? It's not a full pivot to long-term rental, but if we had just been stuck in, and this is something that I've never been interested in, but I've seen a lot of, is this short-term rental arbitrage where you go and rent an apartment building or a house from someone at $100, $200 over market value. Maybe you pay the whole year up front, so the landlord will give you the place, and you say, hey, I'm going to sublease this to Airbnb and do Airbnb on these properties. That's a super interesting idea until you have to pivot, because now going back to a long-term rental doesn't make sense, and you don't own the real estate underneath it. You just had this cash flowing business in the middle, and there's not a whole lot of options to pivot. So when we've come in and invested in these, we've always made sure we had a good amount of options. And the last one being we could sell it. And we've always said that if we wanted to go sell one of these fourplexes, there's a lot of buyers out there for fourplexes, right? It's not a 500 unit apartment building. So anyway, Dustin, thoughts on that?
No, I mean, I think you're spot on, and that it's an interesting maybe dichotomy that's set up here for this episode, right? Of kind of like pivoting versus not, but I think it comes back to like the importance of beginning with the end in mind, right? Like you've got to kind of have whatever that is, whether it's okay, regardless of market conditions, I've got a plan, I'm going to stick with it. And I know that like I've already thought about the market conditions that could happen, and I'm not going to be impacted, so we're just going to keep going. Or by starting with, okay, market conditions might change. We recognize that this strategy will only work in one set of market conditions. So how do we make sure that what we're doing is going to be flexible enough to accommodate any sort of wide changes? But really, it's just like maybe the overarching theme here is like not getting caught up in that fervor of the moment, right? Because there's like, Adam, you know more than I do, lots of folks who got caught up in that Airbnb craze in coming out of COVID, right? 2021. And like you said, the cash flow was crazy and expenses really hadn't gone up then. And all these people got in and thought, well, this is just a super easy way to make money. And it's the same thing as people that would buy apartment buildings underwriting 10% annual rent growth for the next decade, right? They just think it's going to keep going up and up and up and up.
And no expenses.
Yeah. And it never, and like when that doesn't happen, if the entire business plan was based around that one thing with no flexibility for anything else happening, then you're screwed, right? Mm-hmm. Like you end up in this situation where you're now effectively out of options. And so like you bring up a good point too about the arbitrage and the importance of like how that's different. Like you got a lot of people that did that, but it's a different game when you actually own the underlying real estate. And that, again, that's sort of a situation where there's not as much tolerance when things don't go wrong, when the plan doesn't go, whether it's your own fault or the market conditions change, when the plan doesn't go to plan, can you do something different? And when you own the underlying real estate, you bought it at prices that make sense for multiple strategies, then the answer is yes. And then especially for us, buying property with partners, right? We've got partner capital in this. That's obviously very, very important to know that, that capital is going to be protected and that this strategy, even if it doesn't produce the returns of the initially projected target returns, right? We're still doing things and taking action, and we're establishing a plan that's going to preserve that capital.
The part that's maybe interesting off of what you just said is there's times where I look and I'm like, and I think I've texted you about it, I'm like, dude, I think we messed up. I think we did everything wrong. And you're like, well, we haven't lost any money. And this deal's still cash flowing, right? It's just not what we thought, right? And that's not where we want to be, right? There's times where things have to pivot, but having those multiple exits prevents us from being in one of those positions where, like you said, there's a lot of people out there that bought apartment buildings that gave them back to banks or are doing cash calls, right? And we're not doing cash calls, right? There's a difference in what that is. And that's not to say that won't happen to us one day, but having those backup plans and having those different options is important.
For sure. And that's, I've had this conversation with a lot of people, with other GPs who are very disappointed about, like, well, we've had to pause distributions, and that sucks. And I'm not trying to say that, that's a good thing in any way. But, one of our friends and mentors, Jason Hartman, his question is, well, compared to what, right? And if you compare that in some deals, because the correct decisions were made at the acquisition, there was a good plan in place, didn't overpay, didn't take these stupid aggressive assumptions. If the worst case scenario is, well, we have to pause distributions for a few quarters, that's way better than, well, sorry guys, the bank's taking this back, all your money's gone.
When I had this conversation the other night with my girlfriend, I was sitting here, I was like, well, some of these Airbnbs, we have a property management company. Anyone with a short-term rental that's looking for high quality management, I've built this massive quality property management company around my short-term rental management company around my properties. And we have too much staff. We need more listings. We need more third-party listings, because I've just built this huge company to deal with my listings. And I was looking at this, I was like, wow, we lose a little bit of money every month on the management of these units. The units themselves cash flow. And I was sitting here thinking, I'm like, well, what if I have to turn them all back into long-term rentals? And let's even say the cash flow goes neutral, right? We don't make any money every year. I was thinking, I was like, well, most of these I've had for about 5 years, which means about 25 years from now, and I'm 28. So that means, 53 years old, we've got 10 paid off units. That's a retirement, right? I don't have to do anything. Other than manage these units and don't go into default on them. But as my worst case backup plan, we have already built a full retirement. That doesn't seem so bad.
Yeah. That's right? That's an excellent way to view it. Right. Yeah. Well, that's awesome. I don't know. Any other thoughts? I think this may be an episode on the shorter side, but we'll definitely include some links. I mentioned some pieces that I wrote. I'll dig those up and include that in the show notes or release notes if anyone's interested.
I think the only thing left to add is if someone else has an example of this, right, write us an email and we'll bring it up on here. We'll discuss it. If you've got a case study you want us to walk through or something more in depth, it would be a good questions from the audience one, and we can dive through that and give your opinion on maybe what we would have done in that scenario. Not that it would be right. Maybe don't leave in what you did and see if we came to the same conclusion.
Yeah, no, for sure. And guys, reach out, wealthindependencepod.com. We've got a contact form there. We've also got direct contact information for Adam and myself. So reach out if there's something that would make for good topic, whether it's on this topic or something else. Definitely reach out and let us know. We'd love to cover it and cover some more real world examples. Obviously, we've got a decent amount of things ourselves that we've seen, but certainly haven't seen it all. So we'd love to hear more of those. But Adam, if you don't have anything else, we can get on out of here.
Let's get out of here.
All right. Well, thanks everybody for listening. We'll see you next time. And remember, where freedom leads, real wealth follows. Thanks, everybody.
Thanks for joining us on Wealth Independence. This show is for informational purposes only and is not financial, investment, legal, or tax advice and does not constitute an offer to buy or sell securities. All investments carry risk, and investors should always conduct thorough due diligence and consult with qualified professionals before investing. Until next time, remember, freedom leads and real wealth follows.